Hello, good evening, everyone. Welcome to this session, the ASEAN session. So it's 6:51 now, and let's give us some time to get everyone into the room. We have Ben with us today. So Ben, how have you been?
Not too bad. It's been a kind of a hectic day. Was
Yep.
awake yesterday until this morning. Basically tracking the Senate race in Georgia. It looks like the race has been called for one of the Senate seats. So
Yep.
Democrat won one, and they are on track to winning the other. And of course, the U.S. futures has already dropped by 2%.
Yeah, the Nasdaq one, right?
Yeah.
The Yeah, so it's just only like 6 days into the new year, and it does seem like a lot has happened. So you got this Senate race, you got the U.S. Treasuries moving to 1%. You got a lot of different numbers coming into view. So the oil prices reaching $50 mark as well. So I think it's quite a
Uh,
hectic couple of days, I would say. It's
Well,
quite
that's oil is a little bit different because it's
yeah,
because of what Saudi Arabia is doing, right? They're
the cut of the OPEC.
yeah. Well, anyway, that's kind of par for the course. It's what they've always been doing, or rather, is there is precedent in a
Mhm.
sense that either they themselves unilaterally or in a coalition with OPEC as well as Russia, they have enacted drastic cuts before. But all these are kind of the headline numbers because there's always a lot of cheating. Like OPEC as a whole, they say, we want to cut 10 million barrels per day, and then everybody
They
has got
don't
a
do it right.
quota, and then somebody cheats. But it looks like, and of course, although Saudi Arabia is a very big producer, they have got budget issues because the last time, or was it the last time, they did this basically to prop up the oil price, but simply because the U.S. is not part of OPEC, and the U.S. is actually one of the largest producers of oil these days, the shale oil.
Yep.
Whatever kind of price support that Saudi Arabia and OPEC hoped to achieve was basically eroded by the US pumping like mad.
Yeah.
So it's like they didn't really get the bang for the buck that they expected. And Saudi Arabia, they had to burn through their reserves, basically to kind of keep the people happy, social programs and all that. And they don't have unlimited reserves. That's what I'm saying. And worse yet would be for countries like Russia, Venezuela, so on and so
Mm.
forth. So it's not a sustainable solution.
Yep.
Yeah.
So do you I think you have mentioned Warnock is likely to win the Senate, the Democrat, the seat. How about the other one, the
Well,
Ossoff?
the walnut has already been called. I
Yep.
mean that the race has already been called. So he has he has been called, as in they think that he will win the race based on statistics and exit polls and whatever data that's been coming out. For the other one is very close because the last 3 or 4% of the votes left are mainly from the Democrat-leaning
Mhm.
constituents in that state. So which means that the Democrat is going to win more than 50%, and the guy is already ahead by a few thousand votes. So if the margin increases, then it'll be very low chance that the Republicans will win. And the financial markets has already reflected that probability.
Yep.
Yeah.
I mean,
So
notwithstanding that, I think they still have the 0.5% margin. So if they really is that close, it is likely that the loser will ask for a recount, then delaying the whole process again.
I'm sure, and there'll be lawsuits, huh? But the thing is that they do have quite a robust process, so it's not as if they're gonna flip from one winner to the other winner just by a recount. So the margin might, shrink or expand a little bit, but generally, I think it is what it is.
Yeah,
Yeah.
agree. So I think the market has been pricing them in. So you see like you have said, the Nasdaq futures down by 2%, and the U.S. Treasuries up by 1%. So I mean, it could be the fact that we could maybe expect the blue wave to have more stimulus as well as higher tax and higher regulations.
We'll have to wait to see. I think the immediate to do for President-elect Biden would be to increase the COVID-19 stimulus package. So what was passed, about 900 billion, that's probably not gonna last very long. So he'll probably have to push for a bigger aid package. In the longer term, sure, they'll probably have to increase taxes, but I think what they simply do is that the Trump administration's that the tax holiday, right? So when he came in, he lowered tax. That one had a expiry date. So it expires, I think it's 2021 or something. So as long as President-elect Biden doesn't renew that, then of course you'll flip back to its original tax rate. So actually, from one sense, he doesn't actually have to raise taxes. It's just that the tax, inverted commas, holiday is going to expire on its own. And really, when it was kind of levied on the American people, a lot of criticism centered around the fact that the lower taxes actually apply more to the middle to upper income. The lower income people had less benefit from the reduction in tax rates. So I think that will be a little bit more palatable to the citizens of the US. The downstream impact is that obviously people who are in the middle income or upper income, they will generally invest the excess money into real estate as well as stocks and bonds and financial markets. So of course, if these people are taxed more, then there'll be less excess savings to be able to push the capital markets higher. But the flip side is that the central bank, the U.S. Fed, has already committed to more or less unlimited low interest rates to forever. And based on what happened in the 2008-2009 crisis, unlimited low interest rates led to a 10-year bull run. So I think I'm quite bullish on that in the long term, regardless. Yeah.
Yeah, interesting. So I think maybe the last portion being, how do we see this impact the Singapore market? I guess Trump has a lot of those deglobalization, those inward-looking policies. Do you think that they are going to abate anytime soon, especially the tension between the US and China? I think this morning he issued something about banning the WeChat and the Alipay and stuff. So
Alipay, yeah. But it's probably going to be challenged in court because the ban on TikTok was challenged in court and didn't go through actually. So I think there's going to be kind of like tangled up. So it's probably too early to see, right? But the flip side is, of course, the Trump administration was really bad at doing these things because they didn't actually take the time to go through the legalities and to find ways of doing it properly. So they're very bad execution, right? So the guy just said, I want to do this, and then they rush through it, and then they didn't check all the things, and then get stuck in court. But I think the President-elect Biden is going to take a more deliberate and considered approach. And as I say in French, 做水水, right? So you want to push out a new law and all that, you 做水水, make sure that it's worded in such a way where it's going to get through all the lawsuits and and all that. So that was one of the Achilles heel of the Trump administration. The guy was kind of like rush to wait to rush.
I mean, he hasn't been in office for the longest time, right? Whereas Biden has 40 plus years of experience in office. So I mean that will play well to him doing these policies and stuff.
But he also has got a good team. I mean, he's putting together people with experience and clout, and they understand the bureaucracy. It's always been that when Donald Trump came to power, he wanted to drain the swamp, quote unquote. So he brought in people that had very little experience dealing with the government, during bureaucracies and all that. So that's why they find it very difficult actually to push through things because they actually didn't know how the government worked, right? And so I think it's gonna be easier for President-elect Biden to do that. But of course, it's open war on Republicans and Democrats. I think the Republicans will probably revert to their natural obstructionist nature, just as what they did under President Obama, right? So basically, it's going to revert back to the party of no, 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 right? Okay, ladies and gentlemen, it's already 7 p.m. We're going to get started. Let me see. We've got a nice crowd this evening, 35, 36 people. We're just going to push off. I'm sure that as we head into the hour ahead, we're going to have more people joining. We're going to have a little bit of quite a good content today because the pre-submitted questions were quite interesting, and I put together a deck which is 39 slides, which is kind of a bit too much. But we'll try to run through most of these things. And hopefully we do have time at the end, and then we will then allow you guys to ask questions. But we already have got pre-submitted questions, so we're going to get through those first. All right. So on behalf of everybody here, again, Happy New Year, or rather on behalf of SIAS and the team here, Happy New Year to every one of you. If this is the first time you've joined any of our online programming, you are very much welcome. And I just remind you, we have got the weekly market review session, which happens during lunch on Monday, as well as the monthly Wednesday ASIA session, which is a little bit more topical. And over time, we want to talk about subjects which are more related to portfolio management rather than just single stock issues. Because the idea here is that we want to make sure everybody manages their portfolio rather than just stock picking. So as usual, let me just run through the disclaimer. Whatever that we are going to discuss today, specific stocks or strategies or ideas cannot be misconstrued as a recommendation. In all honesty, we are not licensed by MES. We are a charity, right? So, we do not have the authority to actually give recommendations. So before you head out and do anything in the market to execute so on and so forth, be sure to speak to a licensed financial professional. So your broker, your fund manager, whatever, what have you. All right. Okay, so the first question that we have deals with a Singapore stock called AEM Holdings. AEM Holdings, for those of you who are not very familiar, this is a tech company, and my slides have been auto-programmed to advance without me tapping it. So I should have actually checked this beforehand. Let me just quickly see whether I can turn off these. Just give me a second, all right? Use timings. Let's forget about the timings. Loop continuously. Okay, let's start this one again. Okay, so hopefully it doesn't advance on its own. So AEM Holdings is basically basically what they do is they sell chip testing equipment, and their main client is Intel. All right, so the question here, and we're going to go through some of the fundamentals and some of the valuations. And the question here is, why does the price why is it not moving? All right, so it's been stuck in this range for some time. Okay. So let's take a quick look at so what we're going to do first is to kind of look at the fundamentals. Is there anything wrong with this company, fundamentally speaking? That's why, and that could explain why the stock is not moving. But if you look at the profitability matrices, things like operating margin, pre-tax margin, they're actually pretty healthy, about 20%, which is good, right? Operating margin and pre-tax margin is about 20%, which is fairly good. And if you look at things like ROA, return on assets, return on equity, as well as return on capital, they're all very, very nice numbers. Just a point to note for things like return on equity, if you have a number that is about like this, 58, 60%, so on and so forth, that's really good. And it is proven economically. Over time, if your ROE is high, the price will normally grow. All right. So if you see finance stock and the ROE is 5%, 10%, that's not great. right? 30, 40, 50. Oh, that's really good numbers because you don't really see this kind of company very often, and the price should move up over time. Okay. So it's not about the profitability. Now, is it really because the company's balance sheet is poor? So maybe the market is thinking that the company cannot pay its debts. So let's take a quick look on the liquidity as well, solvency of AEM Holdings. The current ratio is at a very nice, comfortable 2.2. Now, what it means is that if you take all the, generically, you take all the current assets and you divide by its current liabilities, right? There is actually a buffer, right? So this is a cover of 1.2. So if you have a current ratio of 1, that means it's 100% coverage now, right? People come to you, ask you for $1, you can give them $1. Okay, that's 100% coverage. But if your debtors come to you and say, hey, can you pay me back my $1? Hey, actually I got $2.20, so I definitely can, as they say in French, right, 打个了啦, right? So 2.2 is actually quite a comfortable buffer. But of course, the current ratio, if those of you who understand or who have an accounting background, you know that current liabilities, some parts of current liability around current assets, for example, current assets, some parts of current assets may not be able to be liquidated and cash quickly. So that's why there is another ratio called the quick ratio. The quick ratio is only looks at the very liquid part of the current assets, and the number is 1.5, which is again more than 1. All right, so the buffer is about 50%. So if again a debtor comes to AEM and says, can you give me back the $1 that you brought from me, then AEM can say, hey, no problemo, I can give you actually $1.50. So you have a buffer of 50 cents. So as you can see from the liquidity ratio perspective, this company doesn't have any problem. There are no red flags. What about a long-term solvency? And one way of looking at long-term solvency of the company would be the debt, assets ratio. Right, so you have got the total debt divided by the total assets, and the percentage of debt as, or rather the ratio of debt as a percentage of assets is a measly 1%. So as you can see, this company has got extremely, extremely low debt, which is good from a business perspective as well, which means that the interest expense is going to be relatively low, and whatever operating income that this company earns, very high chance that is going to be able to cover all its interest payments as well as its principal payments at the end. So this company does not have a problem with liquidity nor solvency, right? So let's move on. And what about the valuation matrix? You have got things like your P ratio, price to book, and frankly, this is relatively cheap because the P ratio of 11.36 is it's historically it's relatively cheap, because for equity I would expect more than 12, like 15 to 18. If you compare to what's happening in the US, stocks are pretty lofty, pretty rich, so the P ratios are normally quite high. If you look like Amazon and all that, the P ratio is wow, 50, 60, 70, 100, whatever. So if you compare this is a relatively cheap company, and the estimated P ratio to growth, P ratio to growth ratio. So how this is calculated is that you take the P ratio divided by the estimated growth, right? Again, the benchmark is flat 1, 1, right? So if it's more than 1, generally it means that this particular company could be expensive because the P ratio is relatively high compared to the estimated growth rate. And if the PEG ratio is less than 1, it kind of indicates that this company is relatively cheap compared to the expected growth rate. And if you look at this is a measly 0.06. So from the PEG ratio perspective, this company is, as I say in French, cheap, cheap, cheap. This is like the little chickens going on some kind of Great Singapore sale, cheap, cheap, cheap. So from this slide, you can see that this company is actually undervalued. Right, and it's got a pretty nice dividend yield. So the indicative dividend yield is about 2.8%, which is not too bad because this is about the same range as you will get from let's say a blue chip stock. All right. So as you can see in the last two slides, we have already taken a quick look. There is no problem with the profitability. This company is definitely profitable. It's well run. The ROA, ROE, ROC is very nice numbers. No problem with the debt. very cheap. So of course the $1,000,000 question is, why, you know, what's happening? What's up, dude? All right. Now, maybe we're reading this wrong. What do the professional research analysts say? The current price at about 4-ish, 5 o'clock today, the price of this stock was $3.58. AEM Holdings, and the consensus target price was $5.03. As you can see, 358 to $5.03 is quite a big upside. Okay, and normally consensus price target is on a rolling 12 months basis. That means all things being equal, in a perfect world, 12 months from today, AEM will hit $5.03. So that's quite a nice upside. It is not like 10% up, it's like what, 40% up? I don't know. So which is very nice buffer. So even if it doesn't go up by 40%, it goes up by 35 or 30%, you can just cash out and make some money. And who are the banks or the financial intermediaries that is covering the stock? You've got a DBS, Maybank, KGI Securities, and of course my old employer CGS, CIMB. So DBS is, or rather KGI is the most bullish. They have got a recommendation of outperform, which is similar to a buy call, and the target price is $5.26. The DBS, all these are buy calls, all right? So recommendation is to add this to your portfolio. And these are basically the range. And CGS, CIMB traditionally, and because I worked in the research department before, they are a little bit conservative. So the target price is 463. But again, 463 compared to the current price of 358 is a very nice, more than $1 up. Okay, so the professional people think that this stock is a good stock. So what's up with this stock? Why is it undervalued? Now, maybe we can approach this from a slightly different angle. There are a couple of factors that I could think of. So as you can see, the main customer for this company is Intel, right? Intel. And I think they used to sell to Huawei Investment Holdings. This is not Huawei, the group. This is basically a privately held related company, Huawei Investment and Holding Company Limited, and Spirox Corporation. Spirox Corporation is a Taiwanese corporation, but very, very small. Market cap is about 150 million Sing dollars, so on and so forth. So really the bulk of the business is coming from Intel. Now let's think about Intel for a minute, right? So if most of your business comes from Intel is of course they run, or rather they provide most of the let me rephrase that. So most of the desktops and laptops out there that use Windows, they run on Intel CPUs, right? The competitor is AMD. So if you look at Intel hasn't been doing very well since 6 months, at least 6 months. For the last 6 months, hasn't been doing well, and arguably for the last year or so, simply because their CPUs are not as good as their main competitor, AMD. AMD is American Micro Devices. So if you are running a Windows-based desktop or laptop, probably 9 out of 10, 8 out of 10, you're running an Intel chip, and then 2 out of 10 laptops, desktops out there are running AMD chips. But AMD is very strong, as in the current offerings of the CPUs are extremely strong, and they beat Intel on a per watt basis. So Intel needs to have a very hot running energy eating chip just to stay on par with AMD. So AMD is extremely efficient, and AMD, the price is cheap, and it's got like 16 core and 32 threads. It's like running your own server, but on a desktop, right? So Intel, I would say, is not doing very well right now, and they've got issues with their fabrication and their plants and all that. So I think if your main customer is not doing very good, and if your main customer doesn't really have a coherent plan to become number one again, I think that's an issue. All right, so that could be a overhang for AEM Holdings. All right, so that's one. The main customer, Intel, not doing great themselves. The second point is that if you look at the price return, AEM has already surged. In the last 12 months, AEM's has gone up by, the price has already gone up by 84.8%. Okay, that's huge for 1 month, around 1 year. Yeah. So I think most people who bought in early, they are very happy. And for people who have not bought in, they might be looking at it and say, hey, it's already been up by almost 85% in the last 12 months. Maybe I missed the boat. Maybe I want to wait for it to come down a little bit before I get into it, so on and so forth. Or maybe it's just a period of consolidation for the stock price. And the reason for that is, and I'm jumping to point 4 here, right? People are waiting for the what's next. So what is the catalyst? So the stock price has gone up by 85% in the last 12 months. What is the? Are there going to be any reasons for the stock price to be pushed higher? Right. So I did a quick check. I don't really see any news on AEM. So there's nothing to push it higher, right? So it's not as if they are coming up with new technology, new product. Maybe it's not as if they onboarded Amazon. No, nothing has changed. So the current price are already surged, and there's no catalyst that can push the stock higher. Now, if we move back to point 3, the free float is only about 35%. So a lot of the shares out there are actually held by institutional money, so like fund managers, sovereign wealth funds, and insiders and all that. So only 35% are actually traded in the open market. Now, this is a two-edged sword, a double-edged sword. The reason is because if only slightly more than 1/3 of your shares are actually being actively traded, if the market doesn't really pay attention to your stock, then it's going to be one of those zombie stocks. It's going to be trading within a range, consolidation phase, right? Because if there's no upside surprise, there's no catalyst, there's no big news, and only 1/3 of the total number of shares are being traded openly, then it's a bit boring. Okay, but it's double-edged sword simply because if you have a big player, a sovereign wealth fund or a fund manager that comes in and suddenly says, I want to buy $10 million, or I want to buy $100 million of this company, then obviously a large proportion of that is going to come out of the free float, and then suddenly the market will jump, will react. Okay, but I think the challenge right now is that there's no upcoming news, no catalyst, so you got no big player coming in to buy this company, and all the retail players are just sitting here wondering what's up. Okay, so I think this is why this company is undervalued. All right. Okay, so that's for AEM Holdings. For question 2, and let me just quickly check that. Oh my God, it's already 18 minutes just on one question. We've got 5 more to go. So for question 2, what are the range of 5G AI stocks that can be considered for 2021? In the interest of time and to keep this a bit short, I only focus on the 5G stocks. The reason is because there are lots of AI stocks out there, but it's kind of early for some of these stocks. So I'm not sure which one to kind of consider. Maybe we'll speak again about AI stocks later on when the the technology and the companies themselves actually mature. So if you're talking about the US, you've got a couple of 5G stocks, and I'm pretty sure you've heard of Qualcomm, right? Qualcomm, and is similar to Qualcomm, you've got Skyworks Solutions, is a much smaller player. Qualcomm modems used to run the majority of the modems in your phone. All right. So if you're your phone, you need to make calls and you need to send data, you need a modem, right? And it connects to the Wi-Fi and all that. And the Qualcomm is very big in that space, so they used to compete with Intel. Intel got out, and you got Motorola, so on and so forth. But Qualcomm is one of the big names. All right, so whether it's 4G, 5G, 6G, 200, 8G, whatever, Qualcomm, very big leader in that space. So a much smaller competitor will be Skyworks Solutions. So this will be the two that basically leaders in the connectivity field. And then you got AMD. AMD is what you call American Micro Devices. No, Advanced Micro Devices. Sorry, not American. AMD Advanced Micro Devices. I spoke about it just now. And just now in that context, I was talking about it in terms of the CPUs, but recently AMD bought a separate company called Zilnex or something, XI something. Don't know how to pronounce it. I think Fang Boon is frantically trying to check it to see the phonetics. All right. Okay, but this company, Zilnex, whatever it is, it's not Xerox. This company was actually a leader in the FPGA. FPGA stands for something programmable, something array. Okay, obviously I'm not a tech guy. My connection to technology basically stops at the PS5, right? But the FPGA, how it works is that this is basically a programmable chip, which means that once the chip is manufactured, they can still program it and then get a chip to do different things, which is slightly different from the semiconductors that we have now. Because if you have a CPU, once you hard code the CPU, right, it will do certain things very fast, but you can't change the basic functionality of the chip. All right, you can program it, yeah, but the boundaries are kind of fixed. But as I understand it, the FPGA, although the hardware is fixed, you can actually add functionality, so on and so forth. And this is a big deal, right? Because when you have a device as small as a mobile phone, you want something that is very flexible, that can extend the capabilities of your phone without actually having to change a chip, right? So AMD bought this company recently, and Fang Boon is going to jump in with the name. What's the name? Zilnex, is it?
Yeah, I think the one of the attendees have answered. So it's Zilin, I think.
Zilin. Okay.
Yeah, Zilin.
Zilings.
Yeah.
Okay, that I would have never guessed that. I know it's ZI something.
Yeah.
Okay, so thank you very much, anonymous attendee, for saving me. So it's so they bought it. So it's it's they bought 100% of it, and this company will be very helpful in AMD's quest to get in on the 5G action. And of course, you got NVIDIA. Now, NVIDIA is a little bit of slightly different, right? So NVIDIA, they're very good at making GPUs, graphics processing units. Basically, this is a graphics chip, right? So if you want to run the latest video games on your desktop, you need an NVIDIA chip. Okay, so you all the bells and whistles, very nice graphics, fast frame rate, so on and so forth. So NVIDIA is very great, very good at that. And of course, in recent years, for the last few years, they've been focusing a lot on industrial or enterprise use of the GPUs, because apparently the chip that runs your latest games are also really good at calculation. So things like servers, things like data science, AI, and all that. NVIDIA is very big in that field as well. So from this perspective, when you have got 5G, you got a lot of content being transmitted, then you want to do something with the content, right? And of course, one of the main things is, of course, to play games on your phone. So if you want your phone to be able to run games properly, then NVIDIA could be one of those players. But of course, that said, NVIDIA is not in the mobile space yet, right? Okay, but they're advancing with that. And of course, if you have got you got 5G, and then you've got your laptop that's connected to have online all the time, and 5G, once it becomes ubiquitous, it's going to be super cheap. Or you can eat buffet. And what do you do with your 5G? You can of course do things on your laptop. You can play, I don't know, League of Legends or whatever it is, and that requires an NVIDIA chip. All right, so these are kind of the four, and I think the AMD is in a good place right now. They've got good products. NVIDIA is the market leader for GPUs, and it was, I think, last year 2020 where its enterprise solutions actually overtook its revenue. In terms of revenue, it overtook its gaming segment. So they are moving more and more into the business sectors, and not so much tied to the gaming sector, because gaming sector is like a fad, right? It comes and goes, so on and so forth. But enterprise, once a company buys your chips, after a while they will probably stick with you, and then they upgrade it, then you got a long-term maintenance contract, so that's all more stable for them. In Singapore, of course, we talked about AEM Holdings, simply because they sell cheap testing equipment. And then you've got others, things like Frenchcon Group, Venture Corp, as well as UMS Holdings. So these are the companies which are not directly related to 5G, but of course they are in the semicon space in Singapore. So if you want to buy, or you want to take a look at something which is homegrown and part of the semicon sector, these will be some of the companies that you may want to take a look at. And of course, not to forget the ETF, the exchange traded funds. I picked out three, and why these three? Simply because I like the AUM, the asset under management. These are fairly big. So the Vanguard Communication Services ETF has got a AUM of 3.2 $3 billion US. So very big exchange rate fund. It's run by Vanguard, right? Vanguard pioneered the low cost index funds business. And of course, many years ago, they also got into the ETF business. So it's a well run company, very respectable, legit, so on and so forth. The next two is the first one is Defiant Next Gen Connectivity ETF. So most of the companies that they take a look at are in the semicon industry, and also specifically in the 5G space as well. And this ETF, the Defiance one, has got AUM of $890 million, just shy of $1 billion. And the next runner-up will be the First Trust. So the issue is called First Trust Index Next G ETF with an AUM of 812. Now, if you take a quick look at some of the component stocks of this ETF, they could be quite similar, right? But the price performance could be different. And because we're all friends here, I've gone through the added putting the added effort to kind of show you the relative performance of the 5G related ETFs that we talked about just now. So hopefully you can see this. If you're out in the gym and you're taking this call on your mobile, probably you cannot. So next time you want to take a call like this, remember bring a magnifying glass. But for those of you at home, let me just quickly orientate you to this chart. This is what you call a performance chart, right? So it's only about 465 days, and this that means slightly more than a year, right? So from March 2019 all the way to today, and let's take a look at what are the things that we have here. The purple line at the bottom, that's the Singapore STI index. All right, that means from March 2019 all the way to today or yesterday Singapore time, the STI index dropped by about 13%. So you can look at it on the extreme right. You've got the what you call the legend, right? The markings there, the tick. So it's between minus 12 to minus 14. So maybe it's minus 12.8%. All right. So that means if you have bought the STI ETF and you held it for 465 days, you'll be under by about 12.8. 13%. Now, what about the rest? So, of course, if we are talking about the US-based ETFs, we're going to compare it versus the the S&P 500. Okay, just a general benchmark. The S&P 500 is the light blue line, right? So, if you have held that for 465 days, then you have made about 33%. But if you look at the Vanguard Communication Services ETF that we spoke about, it's actually up by close to 45%. If you look at the Nasdaq smartphone, the green color one, is also up about 47%, so on and so forth. So as you can see, right, it does appear that the telco or the 5G related ETFs are outperforming definitely they outperform the Singapore market, and they appear to be outperforming the general S&P 500 in the US. But again, let's take this with a grain of salt, because if you look at this chart, most of the outperformance happened only after the COVID-19 pandemic started. Now that kind of makes sense, right? So you've got all the lockdowns, quarantine, circuit breakers, everybody is stuck at home. So obviously, communication type of semicon was very much in play, right? So if you're stuck at home, you're definitely going to have to be ordering a lot more from Amazon. That's why Amazon spiked. Then of course you'll be buying laptops. They're going to give you high-speed broadband. So that's why this company also did very well. So prior to March 2020, these ETFs were kind of performing about the same as the general S&P 500. But after the onset of COVID-19, they outperformed. All right. So this is one of those things where, as I say, there's a season for all things. So timing is quite important. But again, the fact is that the STI index has not been performing very well vis-a-vis US markets. Okay. Now, if the chart is a bit hard for you to see, this is basically, now we've converted that into a bar chart, all right? So you've got all these columns. The one which is second from the right is, of course, the STI index, which is down about 11.5%. And of course, you've got the telecommunications 5G related ETFs all on the left. So very nice numbers here, about 40%. And then you've got the extreme right, which is S&P 500 index, which is up about 34%. So again, these people were at the right place at the right time. So when everybody went through a lockdown, they benefited. Okay, but in the absence of that, as you can see, right, hopefully you can see all these 5G related ETFs were kind of tracking the S&P 500 pretty closely prior to the onset of the pandemic. Okay, question 3. SGI index is around 2,870 points at the end of 2020. SGI ETF is about $2.91.3. All right, the Sing dollars. Is this still a good valuation? Now, as you can see, a long time ago, the tracking error was smaller, so that means 1,000 points STI index would be $1 so it was kind of, but very close. But now the STI ETF appears that after so many years, right, there is trading at a slight premium, which is okay, right? So this is what you call a tracking error. But this is an upside tracking error, so it's kind of trading a little bit at a premium, which is kind of nice. So the main question you need to ask is, where do you think the STI index would be? And from the previous call that we have a roundup of all the forecasts from the major banks as well as brokers in Singapore, and all these analysts project the STI to reach between 3,000 to 3,200 points by the end of this year, 2021. All right, so the most bullish would be Philip Securities, and those guys are generally quite bullish. And as I mentioned, CGS, CIMB are the most bearish, as in not bearish but conservative. Conservative in a sense is a bit good lah. More of a buffer, Kiang-Su, Kiang-Si type of analyst, and their range is about closer to 3,068, so on and so forth. Now, if you think about it, prior to the COVID-19 pandemic, the STI index was actually between 3,000 to 3,200 points. It took a huge dive in March because of the pandemic and the circuit breakers. So what we are trying to say here is that when the thing, if it does go back to that range, 3,000 to 3,200 points, is basically what we call a reversion to mean. That means it's back to normal, right? It is not like higher than prior the pandemic. It's just that you're going to go to about the same level as before the pandemic, but not really dramatically higher. So this is what I call reversion to mean. So if you do believe and think that the analysts actually know what they're talking about, this will be the upside. And of course, the STI ETF would then be priced around $3 to $3.20-ish. All right. So now it's about $2.91. If it goes up to 3,200 points, then the STI ETF will probably be trading about $3.25, $3.30, so on and so forth. All right. Now, the challenge with predicting where the ETF price would land is, of course, you need to kind of forecast where the underlying index will land. And, most analysts don't actually do that. So that's a different type of analyst. It's not a stock analyst. It's more like a macro analyst or economist. That's why you don't have a lot of price targets for ETFs. For the major ones like the SCI index, the S&P 500 index, or Hang Seng index, yes, you do have people that will project that. All right, so this is the answer for question 3. Sorry, so about around this price range. And we do have question 4. So question 4, unlike equities, ETF, exchange traded funds, consists of diversified portfolios, and the underlying will of course be, tracking specific indices. All right. So how to monitor the performance and what sort of performance indicators look for? So this question is quite a nice follow on, from the previous 2 questions, and we're diving into a little bit on ETFs right now. So this is going to be kind of a mini class on ETFs. All right. So what I normally do is, apart from looking at my Bloomberg or whatever it is, if you want to look at a couple of free websites that has really focus on ETFs, 2 of them, ETF.com as well as ETFDB.com. DB stands for database. ETFDB.com, these are based in the US. But because the US is the world's largest market for ETFs, there are thousands of ETFs. This is actually a great place to start. All right. But obviously, if you're looking for only Singapore-specific ETFs listed in Singapore, then of course you can go to sgx.com. So sgx.com actually does have a whole section on ETFs, and then there's a screener on ETFs where you can actually select the ETF that you want based on particular parameters. All right. So for ETF.com, ETFDB.com, as well as sgx.com, all these three websites have got screeners. All right. So if you want ETFs that only deal with particular asset classes or have got certain features, you can use the screener to go check those. And in the interest of full disclosure, we are not related to ETF.com. We don't get paid by them. They don't even know that we exist. Okay. But I can tell you that the free ETF newsletter from ETF.com is actually worth subscribing to. It's free. Yeah? So all you need to do is to sign up using your email address. And again, I'm not promoting them. Yeah. But from an educational perspective, I always thought there was quite a interesting read. So every month the newsletter comes out. Normally it's written by people from the Vanguard Group or State Street and all these big ETF issuers, right? They write opinion pieces, they write things, and then ETF.com actually puts it together, which is actually that means the ETF.com is quite legit, it's one of the most popular websites, and then you've got all these issuers actually collaborating with them. And also, what is quite nice is that at the end of the newsletter, there's actually a list of all the ETF listed in the US based on sectors, allocation, exposure, so on and so forth, AUM as well as expense ratio. So it's you don't have to use a screener. You can just look at it or and all that. And of course, if you're based in the US, you can actually sign up for the hard copy, but kind of pointless in Singapore. They're not gonna send it to you using air freight. Yeah. So just sign up for the soft copy. They send it to you via it's a PDF. Yeah. So just for your consideration. And now this is the screener, okay, based on ETF.com. Very basic thing. I basically told ETF.com, the screener, to show me the list of equity ETFs from the largest to the smallest, all right, in terms of asset under management. And of course, for sure, I'll definitely see the SPY. The SPY is a very popular ETF. The underlying index is the S&P 500 and is run by this company called State Street Global Advisors. So State Street, along with Vanguard, BlackRock, these are the very legit, very large, long history issuers based out of US. All right. So when you kind of trade a product from these companies, they are generally quite safe, huh? Okay. And the reason why I always like to, so the question that we had previously, some of the factors that you're going to look out for, right, for ETFs, right? One of the factors would be AUM, asset under management. Now, most of us on this call are residents of Singapore, but Singaporeans. So when I tell you that, whenever you go to a new shopping center, for example, you go to a new shopping center, you go to the food court, I think the majority of the time we'll probably go to the shop which has got a long queue, right? Because although we have never been to this shopping center, we've never eaten at this shop before, but it's a long queue, then must be good lah, right? So if we see a shop or a coffee shop or a hawker center, and then all the shops are popular and this one has got no queue, then of course, as the implication here is that as Singaporeans, then we'll think that this shop is no good lah, bo ho one bo seng li one, kind of thing, right? So same thing. If you're gonna be playing gambling and all that, you probably want to go to a very big, well-lit, huge casino like Marina Bay Sands, right? You're not gonna go to some dodgy guy in the corner of some Geylang Avenue, like very scary type, right? So you want to go to where all the big players are. So same thing for ETFs. Let's go for the ones with the big AUM, asset under management, because that means that a lot of the investors, globally speaking, are investing in this product. And you can't go wrong with SPY. Look, it's got $332 billion. Yeah, so it's huge. All right. Now there are hundreds or there are thousands of ETFs out there in the world. So when if you use a screener and then you find an ETF that shows you an AUM of 50 million $50 million US dollar, that's very small. 50 million US dollar. I'm sure some of you out there on this call, your net worth is probably about 50 million US dollar, right? So you don't want to kind of choose a product that has got a very small AUM. Go for the big ones. And one reason why you want to go for the big ones is, of course, the expense ratio has got some correlation with the AUM. Generally, the products with the higher AUM have got lower expense ratios, right? Because you've got a huge amount of money being invested, and then your cost is like this, you can spread it out, right? So if the amount being invested is so small, but your cost is about the same, then of course all the investors will take a bigger cut of the expense, right? So generally speaking, larger AUM will lead to lower expense ratio. Some of these are not exactly correct. If you look at the one QQQ Investco QQQ Trust, the expense ratio is about 0.2%, which is relatively high, while the AUM is small. Okay, that makes sense. So AUM is smaller, but expense ratio is higher. But if you look at the one below, the Vanguard FTSE Developed Markets ETF, the AUM is smaller than the QQQ, but the expense ratio is also smaller, which is kind of counterintuitive compared to what I just mentioned. But of course, the reason is the first one, QQQ, is uh, Invesco, right, the company. But this QQQ is the underlying index is the Nasdaq, and the Nasdaq is very volatile, is very hot. So I think they're kind of like charging a little bit more. Right. And the next one, if you look at the Vanguard FTSE Developed Markets, this is Vanguard. They are the pioneer in low cost funds. So, and they are very big, right? So of course they can spread their costs, their overheads across many different ETFs and index funds. That's why they are able to give you a very small expense ratio. Okay, so but generally speaking, higher AUM would generally mean lower expense ratios. All right, so that's one thing to look out for: AUM and the related expense ratio. Now, of course, you also want to look at the performance. Okay, so this particular screener from ETF.com, you can screen for 1 month, 3 months, all the way to 10 years. Because ETFs, generally you're betting on the whole market, like the Nasdaq or S&P 500 STI. On a day-to-day or month-to-month basis, it may not change much, right? Unless the market is very volatile. So for ETFs, I tend to look at the long-term performance, things like at least 1 year, right? 1, 3, 5, 10. If I'm going to be holding this for a long time, then generally I look at it 5 to 10 years out. So if you look at the SPY, this is the S&P 500 ETF. What it means, if you look at 10 years, right? 10 years, the number is 13.77%. So what it means is that for the last 10 years, this ETF went up by 13.77% per year for 10 years, right? If you look at the QQQ, obviously the 10 years, you got 20.38%, simply because the Nasdaq has been doing very well, right? Even more so when the pandemic started, right? So that's kind of the idiosyncrasies of the underlying product that that ETF is trying to track. All right. So generally speaking, for ETFs, look at the longer term performance compared to the shorter term performance. All right. What else to look out for? You can also look at relative valuation matrices, things like PE ratio, price to book. The way you use this with respect to ETF will be similar for a stock, right? So generally speaking, when the PE ratio is very high, then it's overvalued. If it's too low, then it's undervalued, so on and so forth. So you can kind of use that as the guide as well. And as you can see, the SPY, the underlying index, is the S&P 500. So the PE ratio will generally reflect or rather be highly similar to the underlying index. So the SPY has got a PE ratio of 33.64. I think the underlying index also generally has got a PE ratio of about 33.64. And you can see it's relatively high because generally speaking, for S&P 500, the historical range for PE ratio is, I think, about 15 to 18. So this is generally high simply because the price has not gone down, and the price is in fact gone up, but the earnings of the companies in the S&P 500 has dropped, that obviously because of the pandemic, right? So this is just a calculated ratio. So as earnings for companies come back and recover post the pandemic era, then I think the PE ratio will recover to be a more palatable, it'll be cheaper. All right, and then of course you got the dividend yield. Just of course do remember, if you're investing into a US ETF, the dividend will be subjected to a flat 30% withholding tax. All right, so whatever that you see here, minus off 30%. Okay, now let's quickly take a look at the selected ETFs. We've got the S&P 500 ETF, we've got the Nasdaq QQQ ETF, we have got the Vanguard Emerging Market ETF, Again, let's put back the Defiance 5G next gen ETF and look at the STI index. As you can see, the purple line is the one that's maxed out. So if you have bought into the Nasdaq ETF, you have gained about 80%. That's a up. That means you made 80% within the last 465 days compared to the STI index, which is again down by about, what was it, minus 12%, right? Now, this is one way to look at the ETF. Now, remember, ETF doesn't represent any particular stock. It represents markets. So from this chart, we can already see that the Singapore market is not very, didn't do very well in the last 1.5 years. All right. If you expand this for the last 10, 11, 12 years since the great financial crisis, you would also find out that the US capital markets, S&P 500, have vastly outperformed the Singapore market. So it's not because of the product, it's not because of whatever, it's just that for whatever reason, the Singapore market has not been performing that great. I guess things could have improved if Manchester United actually listed here. I think that would have been quite nice, right? But darn it, those guys went and list elsewhere. All right. Okay. Again, if you cannot see the chart, you can have it in the bar chart format. As you can see, the one on extreme right is STI index down by about 11.5%, while the rest of them will be from left to right: S&P 500, Nasdaq, Vanguard FTSE Emerging Market, as well as the Defiance 5G Next Gen ETF. So as you can see, the Nasdaq base ETF, final way, has been the outperformer in the last 1.5 years. Next question, question 5, and I really have to run through this because now we are already at the 7:46 mark. Would you say investing ETFs is a long-term proposition? Rationale is that the only time will tell how the indices will move. That is correct because, as we mentioned previously, we don't really have got price targets for a lot of ETFs. So the big ones, S&P 500, so on and so forth, the broad-based national ETFs, yes, from index, yes, we do have price targets. But if we're talking about, let's say, the Vanguard Emerging Market ETF or the Defiance 5G Next Gen ETF, generally we're not going to have that. So the question here is, if there's no price target, then is it we just hold on now? Is that how it works? Okay, there are two parts to the story here. An ETF can be used like any other security. You can, of course, invest in it for the long term, and you can also trade it. Now let's deal with the investment part of it. So as usual, you can buy and hold because it's like a stock. And the thing is that when you buy the STI ETF, for example, you're buying part of units of every one of the 30 component stocks in the STI index, right? So you can buy and hold, and then you can still harvest it for dividends, so on and so forth. So you can hold it forever, lah. And unless the Singapore market disappears, I don't know, like alien invasion. I don't know, maybe there'll be an alien invasion in 2022. But the fact is that if the company doesn't go down and it's still the Singapore market still exists, SGX still exists, you can just sit down and just hold it and forever, and then you get dividends every year. Now, the great thing about this buy and hold strategy with an ETF is that you got built-in diversification. So, out of 30 stocks, some of them may die out. That's fair. But then because it's the top 30 stocks, if a company actually dies out, goes bankrupt, then of course this company will be removed from the index and therefore removed from the ETF, and then you have a new company coming in, right? So it does not affect the ETF as a product. It basically affects it will slightly affect the makeup, the idiosyncrasies of the price movement of the ETF, but the product is still there. You can hold it forever. Okay, and what you're really doing is to bet on specific markets, right? So you have got a long-term view of how the Singapore market may perform vis-a-vis the US or whatever, and then you can put in a position, right? So you're really just bearing market risk. There is no specific stock risk, so it doesn't matter if one company drops out. Doesn't matter because the ETF and the index will always be there. So that's the great thing about a buy and hold strategy using an ETF, right? And the ETF is highly liquid. You go for the big ones. You can trade it like a stock, so on and so forth, in open market, right? So it's all good from a long-term investment perspective. And really, the built-in diversification is paramount. That's why it's better to hold an ETF compared to a stock, because a stock later on you might just go bankrupt, right? But ETF will it will always be there. Okay. Now you can also trade it. So you can trade it like a stock, right? And honestly, I've been trading, personally, I've been trading leverage ETFs based on the Nasdaq for the last few months, actually. All right. So one way or one method to trade ETFs is basically to look at relative strength. So when you're trading, and this ETF does not have any price target, it all comes down to technical analysis. Yeah, execution, timing, technical analysis. And one thing that I like to look at is relative strength. As in, is this ETF performing better, relatively better compared to a different ETF, or is it performing relatively worse compared to a different ETF? All right, so I'll come to that in a little bit. Now, what's a leverage ETF? A leverage ETF means, as the name implies, there's leverage. So the one that I trade is the TQQ. Now, remember, just now the ETF we're looking at is QQQ, right? The underlying is the Nasdaq 100 index. The TQQ is actually from a different provider, but it provides 3x, 3 times leverage to the performance of the underlying Nasdaq 100 index. So if the underlying Nasdaq 100 index goes up by 1%, this ETF will go up by 3%. Of course, losses will be amplified as well. If the underlying goes down by 1%, then this ETF will lose 3%, all things being equal. But the nature of the leverage ETFs is that they tend to have very low tracking error in the short term, but over the long term, like many years and decades and all that, the tracking error tends to be amplified. So leverage ETFs, you shouldn't buy and hold. You should just use it to trade. Yeah. Okay. So that's a possibility. And the reason why I trade leverage ETFs is because ETFs, you're betting on the market. The market doesn't move very fast every day, right? Or even a week, except for today, when the market will crash by 2%. Okay, but this is fine, few in between. So every day the market will go up and down by 0.5%, 0.3%. It's very hard to make or lose money that way. So to give it more oomph, as they say, right? You go for a leverage ETF. So leverage ETFs, you're not going to invest it, not going to hold it for a long time, but it's a possibility to trade it. Okay, but it's not for the faint-hearted. Make sure that you have got enough cash in your account to do this. And again, not a recommendation. As we said before, not a recommendation. Now let's look at some of the relative performance of some of these ETFs. The red color one is the basic S&P 500. The purple color would be the 3 times leverage ETF, 3 times S&P 500 leverage ETF. The green color is the 3 times Nasdaq leverage ETF, and the pink color is the SCI index. Now this is a what is this? This is a 11-year chart, is it? 10-year chart. Okay, it's slightly less than 10 years, meaning 9-year chart. Okay, 2,690 days. As you can see, or maybe you cannot see, the STI index is, I can't even see the pink line. It is very close to zero. I don't know. Okay, but of course the scale is very large. If you look at the red color, which is the basic S&P 500 ETF, it's somewhere between 0 to 500. So maybe over the last 9-10 years, you went up by about 250%. Okay, that's all right. You look at the blue color one, is your 3x S&P 500. It went out by about 2,000%, which is 20 times. And the green color one is the super fabulous Nasdaq-based leverage ETF, which has gone up by 105 times. Now, as you can see, 105 times is not 3 times. It is definitely more than 3 times. And again, as I mentioned, if you hold this over a long time, the tracking error kind of amplifies, right? So you should never hold a leverage ETF for a long time, because you're definitely gonna be making much more than you expect, and you'll be losing much more than you expect, because the 3x kind of get stretched out. But as you can see, you can still trade this, and you trade it from a day-to-day or weekly basis. So definitely you can still trade ETFs. Again, a different chart that shows the relative performance. The big green column here is the Nasdaq base, three times leverage Nasdaq ETF. Okay. Now, just like I mentioned, relative strength. So relative strength is basically a method of you want to decide which ETF is stronger, relatively speaking, right? Now, this is from stockcharts.com. Stockcharts.com is basically a free website. Again, in the interest of full disclosure, we are not related to them. We don't know them. They don't know us. It's basically a free website. I'm not putting this up because I'm being paid. They don't even know I exist, which is how I like it, right? So this is a free website. And as you can see on the top left, the symbol The symbol is SPY colon $STI. Now, this is the only website, or maybe even the only like platform. You got a broker's platform, right? The only platform or website that I've seen where you can take the price of one counter divided by the price of a different counter. Basically, what I'm doing is I'm telling the system to take the price of the SPY, which is the S&P 500, divided by the STI index. All right. Now, we don't really care what the ratio is. You look at the right-hand side, the ratio is 0.13, 0.12. Those are meaningless. It doesn't matter. What I'm interested in is looking at the chart. Because if you take the S&P 500 divided by STI and the chart keeps going up, basically it means that the S&P 500 is going up faster than the STI index. Another way of looking at it is that the S&P 500 is dropping slower compared to the STI index. Doesn't matter. What it means is that relatively speaking, the S&P 500 is performing more strongly compared to the STI index. And if you look at this is basically slightly more than a year, 2 years. Definitely the S&P 500 has been showing leadership, going up compared to the STI index. So obviously you got two choices, right? Should I invest in the S&P 500 ETF or the STI ETF? And then you look at this chart, hey, the long-term trend is that the S&P 500 is going up faster compared to the STI. So, maybe you want to take a look at this. But you can also employ or apply all your technical analysis toolkit. And if you look at the last few months, right, it's kind of flat, right? And it's coming down actually. So which means that the STI index is kind of moving up faster compared to the S&P 500. So that could be an idea there as well. So in the short term, you could also consider that as well. Again, not a recommendation, right? And you can use the same RSI, MACD. RSI is kind of about 54. No direction there. But you look at MACD, it's moving down, right? So moving down means that this chart is going to go down, which basically means that the STI index is going to perform better than the S&P 500 ETF. Right. So if you know something about technical analysis, you can use the same tools to basically analyze this. And again, this is a free website, and this is the only one that I've ever seen where you can actually take one counter divide by another counter. I've never seen anywhere else. So this is all great. Of course, the problem is that this stockcharts.com is a US company, US website. So you cannot take Sambong Marine divided by Capital Land because don't have. All right. So this will only work if you're looking at the STI index compared to something else, or just US company compared to US company. All right. So hopefully one of the local brokers can build this in if they have not actually already done so for their platforms. And the last question we have is, following the recent failure of Ant Financial's launching of its IPO, China has ramped up its regulatory control on the tech giants and so forth. So what is our take on the risk of investing in ETFs? So you got a lot of ETFs, technology-focused ETFs. That has got all these China-based tech companies like Alibaba, Tencent, and Meituan. My high opinion is quite good, right? Meituan is correct, right? Yeah. It sounds like a beauty product, cosmetic. Okay, never mind. All right, and so how does this affect the ETF? So the question basically is, you got regulatory concerns. They will impact the tech stocks. Tech stocks are part of the ETF. How does this impact the ETF? All right, there's a bifurcation here. There's a split here, because if you look at the regulatory regime in the US as well as in Europe, US, there was a lot of Facebook bashing, Twitter bashing, and all that, simply because of what happened in it's a presidential election, the cycle, right? Politics, right? So the Republicans were bashing Facebook and all that for censoring, as well as labeling President Trump's posts. And of course, the Democrats were again bashing Facebook and Google and all that, simply because they felt that they were not doing enough to rein in their anti-market behavior. So anyway, the Democrats and Republicans had good reason or good political reasons to bash all these companies. But guess what? Election season is over, right? So it's going to be back to normal. The politicians will then bash each other on some other things and they'll forget about these companies, right? So President Trump wanted to impose restrictions on the tech companies, and he actually vetoed the defense bill because of that, but his veto was overridden by the Congress, so that's going nowhere, and he'll be out of office soon. So that's probably going to be a dead on arrival, right? Now in Europe, over the years, you can also trust Europe to keep bashing the U.S. tech companies simply because they are U.S. tech companies. If this was a German tech company, that is what they say in French, 两码事, right? So of course, Facebook, Amazon, and all that, Europeans are a bit unhappy that all these companies are making tons of money and all that, and they're not paying taxes and all that. So that's why in Europe there is a lot of momentum behind this technology tax, right? So technology companies which are raking in revenue in Europe generally are not taxed, or their tax very low. So they want to have a EU-wide consistent tax regime that is gaining momentum, and regardless of US politics, that's probably going to come to the forefront this year. All right, so President-elect Biden, depends on what he's going to do, right? So if and the French are really on about this, but again, historically speaking, the French don't like the Americans. This is beyond the scope of today's call, but you can take it as 他们不是很好的朋友啦, pardon my French, right? Okay, yeah, so that is kind of the forefront here. If you look at the Chinese regulatory regime, it's a little bit different because there are different sectors. For example, like the banking sector in China, there's been a prevalent problem of shadow banking. That means a lot of the transactions out there are not strictly regulated, right? I'll give you an example, right? This is very common in China, right? So if let's say you are a Chinese tycoon, you're based in China, physically you're in China, you got millions of dollars and you want to move it out, well, it's going to be a bit difficult because you got currency controls, you got, whatever, right? You go through the government, but you can just go through a middleman. So what happens is that you tell a middleman you want to move your money from China to, I don't know, the UK, right? And what happens? You go to the middleman in China will call the middleman in UK. So if you're in China, you give your money to the middleman in China. The middleman in China will call the middleman in the UK. The middleman in UK will then give an equivalent amount of money to your bank account in the UK. But actually, the two middlemen, the money doesn't actually flow through borders. That's what you call shadow banking. Because if you actually want to transfer account from here to there, go through borders, you need to go through the formal banking system, and then there'll be regulations, right? But it's not. There are capital controls, right? So you can't actually do that. So what you do is that you go through a middleman. Of course, the middleman is not licensed. It's like it can be some dodgy fella, but you go to somebody you trust. Right, so you pay this guy. This guy will call his cousin over there. The cousin will then, from his account, transfer to your account. So to you is okay. I move money out. All right, but to the financial system is that no money was actually transferred between borders. Now this is shadow banking. Now this is actually not good, right? Because then the government will not know what's happening. Money being moved in and out. It's in violation, and it impedes or hinders monetary policy, right? Because you can't control money supply. Right, so this is a big problem in China, right? It's shadow banking, and again, part of shadow banking is P2P lending and all that. And Ant Financial, from what I've read, is that some of the products and all that is not. I wouldn't say it's illegal, but it's not. It's like a gray market, right? It's not. The regulations are not that well set up, or the regulators have not actually thought about it, and it's kind of like skirting the formal banking rules. So Ant Financial is, regardless of what you read about the politics, or Jack Ma has been enemies of the government. Okay, that's aside. That's aside. That's like Trivial Pursuit. That's aside. But from a purely financial regulation perspective, this is kind of in line with what the government has been doing for years. They need to kind of control the shadow banking sector, right? Because they need to bring it within the overall the regime of regulations and all that to make it kind of safe for everybody. So this is kind of specific to fintech as well as and financial. So things like, if let's say it's a Chinese-based P2P lending and all that, I think the Chinese regulators also will take a good hard look at those people. Okay, so that is specific risk. Okay, now and of course you can also look at Tencent, right? So Tencent, you got the WeChat, right? WeChat, something like WhatsApp. Okay, so that's communication. But Tencent also has got a lot of, mobile games and all that. And over the years, the Chinese government has cracked down on video gaming because, it's for us, it's kind of like kind of weird lah. But the government in China is like, there was one time they kind of regulated the opening hours of internet cafes because a lot of students in China, they go to internet cafes and practically they live there like 24 hours, right? And they play games like StarCraft, and I don't know what Fang Bun plays nowadays, but he looks like a very serious gamer. Now, but so the Chinese government actually clamp down, right? There's a maximum number of hours you can actually rent your PC out and all that. And and of course, currently there's a huge clampdown on apps on the Apple Store in China, simply because a lot of these video games that's available for purchase on the Apple App Store didn't have the license. As in, you're supposed to go to a government agency in China and get a stamp of approval, quality control, right? And they didn't do that. So over the last few weeks or so, there's been newspaper reports that Apple had to get rid of thousands of mobile games from their Apple App Store simply because they didn't get the job. Yeah. So that is kind of, again, very specific. And again, it's not because of anything. It's just that this is the Chinese government trying to make it safe for youngsters to play video games, right? So it's one of those paternalistic things, right? Whew, good thing there are no restrictions on video gaming in Singapore. Yeah. I mean, if you want to spend your 24 hours during the COVID-19 circuit breaker playing video games, more power to you, right? Okay. All right. So my 2 cents worth. I think the regulatory concerns in China are moderate, but it's a bit overblown because there are specific reasons why they are doing it. So I don't think they're clamping down to clamp down. I mean, there are specific gaps in the regulatory regime that they need to kind of fill up, right? In the US, I think the regulatory concerns will die down simply because it's no longer the election season. But one risk factor would be if the Europeans do go ahead with the technology tax, then President-elect Biden may respond. So this could be another point of friction between the two trading blocs. Okay, I don't think this is going to be anything more than that, though. All right. Now, since we are talking about technology stocks, we don't have analyst recommendations on ETFs, right? But we do have analyst recommendations on the some of these more specific technology stocks that was brought up in the question. For example, Alibaba Group, as of today, and we're talking about the Hong Kong shares, not the shares, not the equivalent listed in the US. We're talking about the Hong Kong one. All right, so you have got. So these are the recommendations. Okay. So if you're interested in these companies, you can take a quick snapshot or write it down, so on and so forth. I'm not really going to go through this because we are not going to talk through the fundamentals of this company, so on and so forth. So this is just a snapshot of what the professional research analysts think of these companies, right? Okay. Now, generally speaking, you want to look at companies where the vast majority of research analysts do say that it is a buy call, right? Again, take it with a grain of salt because most research analysts will say buy lah. Okay, but of course you want like 100% or 95% of all research analysts to say buy. Then you feel more confident, right? If you have got 50% of research analysts say that this is a sell lah, that means probably it's closer to 75% of research analysts say sell lah. Right, so you always take it with a grain of salt, right? So yeah, they're very bullish, but take it with a grain of salt. If they're still bullish, then okay, maybe there's some meat there, right? So as you can see, Alibaba as well as Tencent, the vast majority of analysts say it's a buy, and the target prices are fairly high compared to the current price. So there's a nice upside potential. Okay. The next bunch, you've got the Meituan, all right, which is again a buy call. 47 out of 52 analysts say buy. And we move down to Amazon, which is of course US based company. Amazon has come down quite a fair bit on Monday night, simply because of the market volatility with regards to the Senate race in Georgia. All right, so it's on Monday kind of dropped quite a fair bit. The consensus target price is quite a large number, $3,823, and current price as of last night was $3,218, so on and so forth. All right. But the good thing about the US market is that you can actually buy one share. You don't have to buy like lots of 10 or 100. You can just buy one, really. Yeah. So you can do that. And there's also fractional pricing. That means you can just tell whatever your broker, I don't know, some brokers, you can say, I want to spend 3,000 US dollar on Amazon. Then you think, oh, $3,000 cannot even buy one share. No problem, because the broker will then buy 0.9 shares. Or rather, you allocate 0.9 shares to you. Now. The broker will buy one full share, but allocate 0.9 to you. All right. So that's also possible depending on the broker that you're using. All right. So don't be frightened by the large absolute number. There are ways around that to mitigate that. Next bunch, you got Facebook as well as Netflix. Now, Facebook and Netflix, they are actually a small percentage of analysts that actually say sell. So for Facebook, 3 out of 56 analysts, about 6% or 5% say sell. Netflix, 6 out of 44. Yeah, also say sell, but the vast majority say buy. And of course, whatever that's not buy or sell will then be hold. But as you can see, the vast majority of this, you know, covering analysts covering the stocks say buy. And of course, the last big one would be Google. This is the Class A shares. Class A shares is the one that comes with the voting rights. So I did a quick check. The Class C share is the one that without the voting rights, but the price is actually about the same. So might as well get the one with the voting rights. Just in case you feel like going out to California and then joining the AGM and then asking them for a free buffet. I don't know. So if the price is about the same, go for one of the voting rights, because then you become a voting share member, stockholder. All right. Then you can go to the AGM to 做 one, just for fun. Okay. But of course, don't tell them you're Singaporean. That makes all of us look bad. So Class A, the one with the voting rights, current price 1,740, and consensus price target about 1945, right? 1,945. About 10% analysts say sell. Okay. So as usual, you can all take all these numbers and statistics with a grain of salt, because of course, obviously, we're all dealing with an imperfect market. As as time progresses, more information will hit the market, and of course, all this whatever will change over time. All right. Okay, and we are now 12 minutes past 8. We have surpassed the time allocated to us, but that's really because we have got quite a meaty content today. I think in the interest of time, we will not cover the questions that we have. We've got 3 questions: nanofilm, prospects of nanofilm, and we have got energy stocks. I think we will leave that for the next round, all right, in the interest of time. Okay. Now, before we let you off, we also have, do we have the closing slides? We also have a bunch of closing slides for which you can see the QR code. So again, just a little bit of xiao koyo here. If you're not on our mailing list, then please do sign up if you want. And to get on our mailing list, so you know what's happening. And of course, we would also invite you to join as a member. Our membership fee is $12, $1 per month. It's basically the same price as 2 McDonald's Happy Meals for 1 whole year. Right. This is just about the extent of my selling to you. Okay. We tend to try, we are analysts, me and Fang Boon, so we don't really like to sell things. Okay, but really $12 for full year membership, I think it's probably a no-brainer. Yeah. Okay, so that's it from us at our SIAS studios. Thank you very much for joining us this evening. And if you have any feedback, do complete the feedback form. You can see the chat screen, so on and so forth, so that they will help us calibrate our programming going forward. We are, as you know, a charitable organization. We are a registered charity. We don't really make tons of money. We don't really make money anyway. Okay, but the thing is that we want to make sure that we do provide the information that you, our constituents, we want to see. Yeah, so we want to provide value to all these seminars that we have. All right, so nanofilm as well as energy stocks, correct? Let's KIV this, and we'll deal with it the next round in February. Okay. Any famous last words, Fang Woon?
No. So I think everything is fine.
Okay. And it is a wrap, as Genevieve has mentioned. Thank you so much for your time this evening. We are so sorry that we overran, but hopefully you got something out of it. And again, CK, thank you so much. CK has been with us for a long time since we did the investment chapter course last year. So hopefully you got something out of it, CK. So good to hear from you as well. All right. So from us to you, thank you very much. Have a, again, good new year. And we will see you again next month, February, for the SIAS session.